Okay, so let's start our next class, GASB update. We have one of our audit partners, David Alvey. Fun facts about David. He's been with the firm for 12 years. His favorite movie is The Fifth Element. Is it a good movie? Yes? Okay. And if he were not an accountant, he would have loved to be a drum photographer, not a professional stalker, just a drum photographer. Please help me welcome David.
Great. Thank you. All right. So who's ready for GASB update? That's for my special district, my utility district out there. It took us a while to find a pipeline. Before I start, I was finishing up my slides and I was kind of getting a little bummed out. A lot of my thunder was taken from me, 74, 75, we already talked about that. We mentioned a little bit about 73. So I told my wife I want something to liven up my presentation. And she was my high school sweetheart, been married now for 14 years. And so she knows me. I mean, I met her before I took my first accounting class, if that's anything. So I talk about all the new upcoming GASBs and things that I find in my job. And I'm like, why don't you write me some jokes? So as a true auditor, I was like, okay, put them in an Excel spreadsheet, give me a formula for a random number generation, and then we'll pull a sample of your jokes. And so she gave me this. So somebody throw out a number between 1 and 10, and let's see how she did. 7, okay. All right, how can you tell a finance director is getting soft? They actually listen to department heads before they say no. All right, so throughout, we'll check out some jokes. And these have not been vetted, these have been vetted by my children, 7 and 5, they thought they were hilarious. If that doesn't mean much to you, my oldest child, when she was first born and I was reading to her at night, is when I was studying for the CPA exam. So I would read to her my Becker CPA review books. So she's a very compliant one. All right, so for this year, we have pensions not within the scope of 68, and we kind of mentioned those about 73. Mary Beth touched on that a little bit. We have 74, we've beat that one to death. 77 tax abatement disclosures, 78 certain multiple employer pension plans, blending requirements, and pension issues. So this year, if you're not early implementing 75, it should be easy. All right, next year, not so much. So we have 75. We have irrevocable split interest agreements, the Omnibus 2017, and certain debt extinguishment issues. And then in 19, we have certain asset retirement obligations, fiduciary activities, some guidance there. And the last year that we have, the last issued GASB is 87, that has to do with leases. So for any 12/31 fiscal year ends in here, I didn't think there were on the list, but just in case, we put the slide in there so you can see when your implementation dates are. So starting with GASB 73, accounting for pension plans not within the scope of 68. So this applies, let me get my slides here. So not within the scope. So there's no trust, and if they were in a trust, it would have to be irrevocable trust. It would have to be set up for planned payments, and it would have to be protected from creditors from both the employee and employers. But so that's not the case here. There's no trust. Most of these had no assets. So you don't get the benefit of the net pension liability, or I'm sorry, the fiduciary net position to offset your total pension liability. It requires pretty much the same footnotes as GASB 67, 68, so you're going to have the same footnote disclosure, a lot of the same RSI, 10-year worth of information once it becomes available. And any assets held, if there are any assets, have to be reported as cash or investments within the city because they're not put in trust. And because they're not put in trust, you don't get the benefit of that long-term rate of return. You have to use the yield of a 20-year tax-exempt bond, the ratings of AA or higher. And it clarifies some of the disclosures where they want you to put in items that you have actually the ability to change. You know, you're not going to be able to change how the market what happens in the market, but if there's some kind of change in your funding, that would be something you would disclose. And we talked earlier, 73, kind of the sleeper, is the supplemental or the replacement benefit plans. So those are the ones for those high income retirees. It's actually 210,000 is the IRS limit. If they're over that, then that supplemental amount, they would have to go into that replacement benefit plan. And so that's something that you need to look at and see if they're material enough to disclose. Okay. And the kicker about that, and I thought this was kind of horrible when Mary Beth mentioned it, that CalPERS won't tell you if these retirees coming up are going to be in this plan. They don't know until the actual retirement date, and then they're required to go into this. So it's not something you can really prepare in advance. All right, 77, tax abatement disclosures. So I'm going to read you the definition here. Well, actually, I'll just let you guys read it. But really the key is these two things. So a promise to forego tax, and there has to be a specific action after the agreement has been entered into. Okay, so again, these would have to be large abatements. So our office is in Pleasant Hill. We're going to build, I should probably tell our CEO this, but we're going to build a maze campus, and it's going to be huge. And we're going to get the city to give us a discount on our property taxes if we promise to employ 50% of our workforce from the city of Pleasant Hill. So that would be an example of a property or a tax abatement. So they're usually to encourage economic development. And to clarify from last year when we did the GASB update, we were under the, when we read this GASB, it read like that if we got the tax, like property tax, if it was property tax, if we got the property tax and then wrote you, developer, a check as a reimbursement, that wouldn't fall under this type of an arrangement, okay? But Catherine called GASB, sure that was fun, and they told her that that doesn't matter. No matter how the money gets out, it would be a tax abatement. So the note disclosures, you have to distinguish between your own tax abatements and others implied or imposed on you from other governments. So like a city's own abatements, and then also ones maybe a county imposed on you. You can disclose them individually or in aggregate, and it gives you guidance on a quantitative threshold. So that's a threshold that you would use to disclose individual tax abatements, or here's all my property tax abatements in total. And it's really up to professional judgment. It can be a percentage of revenue, it could be a dollar threshold, but eventually, and I'll show you the notes to that, or what's required in the footnote disclosure, but that quantitative threshold needs to be disclosed. And I think why GASB did this, one, is they want to show the citizens what kind of tax is being foregone. I mean, if you're giving away the farm, they want to know. But also, they gave you that quantitative threshold and the ability to lump things, because this could get lengthy. I mean, you literally have to keep these on your footnotes so long as the term is active. So here are the requirements for the government's own abatements and then opposed on the government. And you have this in your slides so you can look at it. It's a little hard to see up here, but some of the highlights, a general description of the program, the amount of tax foregone, the type, property tax, sales tax, and then that quantitative threshold, what threshold you're using to break out individual or in total of these abatements. And there's also a, in the GASB talks about if the information is confidential. So if there's some reason why you don't want to say what the developer's name is or the amount of money, or if there's an arrangement, if they hit a certain revenue goal, sales tax, you can actually do a really high level and you don't have to discuss that in the footnotes. So that's June 30, 17. And you can see that the disclosures are quite a bit less if the abatement is imposed on you by like the county, because theoretically that would be in their report. All right, so 78, pensions provided through a certain multiple employer benefit plan, pension plans. So this is really the Taft-Hartley style plan. Does anyone have a Taft-Hartley plan or know of one? What it is basically a plan that has no, well, here it is. It has no state or local, or it's not a state or local pension plan. It provides benefits to both government and non-government employees, and there's no primary government. And they're usually planned around like unions or some kind of trade. So if there's no primary government, then GASB is saying it's going to be too hard for you to get this information. You don't have to do 68. So 80, the blending requirement. So this one just adds an additional requirement to blending for certain component units. So the old requirements is the governing body has to be primarily the same. The services have to benefit the primary, and it is kind of assumed that if the component unit is in default, the primary government will pay off its debt. So those are three. And they added one here for the not-for-profit, where the government is the sole corporate member, and that has to be outlined in the bylaws of the not-for-profit. And so what they're saying is this is a unique relationship between a municipality and a special district. And really the kicker that some of these weren't being rolled into component unit is that first requirement that the governing body is primarily the same, because a lot of these not-for-profits have governing bodies of local citizens or not people on council or boards. Okay, so that's June 30, 17. Pension issue, so 82. So did anyone implement 82 early last year? It was kind of, we recommended it just because, so you could be in compliance with the covered payroll piece. But there's three components, and so the first component is deviations from actuarial standards of practice. So I talked to Mary Beth during the break, and she really couldn't think of really any deviations that she would seen. So basically saying that if there's a deviations from the actuarial standards of practice, that report cannot be in compliance with 67 or 68. It also changes, we all know, the covered payroll versus covered employee payroll, where covered payroll, which is now what it's going to be, is the payroll in which contributions are used to calculate. So that's going to be the new one in your required supplemental information. And then it gives a classification for employee paid member contributions, and just says basically if the employer is going to pay for the member contributions, you have to treat those just as like any other non-pension compensation, so salaries and fringe benefits. So treat that accountantly that way. Okay. So funny thing about the actuaries, when I first started reading these actuary reports a long time ago, I played with the idea of becoming an actuary, and it makes a CPA exam look like a cakewalk. I almost want to throw up when I looked at the requirements to become an actuary. And I joked around with Christine Perros from Daly City, and also you don't want to become an actuary because it's really not good to know with a high statistical standard of when you're going to die. No one should know that. All right, 81. Irrevocable split interest agreement. So this has to do with donations. So and a lot of these donations are done for tax benefits of the donor. And it really breaks it down to three standard, or I guess these are more common tools, usually done in trust. So you have a charitable lead trust. So that means throughout the life of the trust, you get money, little increments. You have a charitable remainder trust where somebody else gets money throughout the life of the trust. At the end, you get the remainder. And then a life interest in real estate means you basically get the real estate when that person dies or that trust is terminated. I see those sometimes in like open spaces where someone will give as part of their trust an open space, a piece of land, but they want to use that land through their life, and when they die, you can have it. So I don't think these are going to be very common. And with anything, materiality comes into play. So it really boils down to who's the trustee or the agent, who has control over those assets. If it's the government, then you're allowed to book a receivable for a lead trust, so that amount of money that you're going to be coming through. But you have to book a liability if there's any payout that you have to do to the beneficiary. So with the split interest, there's got to be two people in all three of these. There's got to be a government agency and a non-government beneficiary, okay? So if you owe that non-government beneficiary money, that has to be a liability on the books, and then you would back into or plug your deferred inflow. If it's a life interest in real estate, capital asset, you have to look at, it depends on what you're going to use that capital asset for. Is it investment? If it's an investment, then it's subject to GASB 72, and you have to do a fair market value adjustment on it, right? And it's probably going to be level 3, and you're going to have an appraisal done. If it's just a regular capital asset, you would capitalize it, you would depreciate it over the life, and then you would offset that with a deferred inflow. And so for all of these, you would recognize the revenue at the end when this is done, and your revenue would basically be that deferred inflow. Now, if the third party holds the asset or is the trustee, you have to kind of walk down this path. So is the government specifically named in the legal document, in the trust document? Is the agreement irrevocable? Is no power given to the intermediary? And does the donor have any control of what happens? And can the government sue if that person doesn't, or if they somehow don't get the assets? The measurement is a fair market value every year. The changes in fair market value would be that deferred inflow of resources. That's the piece that will change. That's the plug, essentially. In a lead interest trust, you would have some revenue through the air, but in the remainder interest trust, it would be, this is not full. Oh, well. You would recognize the revenue at the termination of the agreement. Sorry, and that was, yeah. So that was June 30, 18 for their split interest agreement. So the Omnibus. So this is kind of the catch-all. This is basically everyone misinterpreted a piece of a GASB, and this is GASB just saying, let's fix it all in one fell swoop. So the merging of component units. So this has to do with standalone business-type entities that show their financials in a single column. And there was some confusion that component units, they have an option to merge or not merge component units. And so GASB said, no, you still have to follow the guidelines. And if it's a component unit, you walk down that path, those questions, you still have to show those. Goodwill and negative goodwill. So this came out of GASB 69 that had to do with combination of governments and disposal of governments. So, and 69 was from that was a couple years ago, from that date forward. So there was a lot of these people that had goodwill on the books that didn't know what to do with it. And so the question came up, do we leave it as goodwill? And going forward, if there's any, we'll do it as a deferred outflow. And GASB said, nope, you have to now move that goodwill to a deferred outflow, and you're going to amortize that. And if it's a negative goodwill, you have to reduce your asset value if you were the one getting the government. And that could, depending on the materiality of that restatement, that could be a restatement based on the amount. Real estate held by insurance companies. This was just a clarification of, there was some confusion about a unit of account in real estate. And this was so GASB clarified the definition of GASB 72, the fair market value of how to value those real estates. Okay. Investments in certain money market investment, or in certain money market funds at amortized cost. This was a change, again, a verbiage change that allowed amortized cost. You could use amortized cost and it wasn't required but recommended if the issuer's credit rating does not significantly change the fair market value of the asset that they're selling. Again, just a verbiage change. The timing of pension and OPEB, this is a clarification, and we kind of talked about that part earlier. The on behalf payment, the example of this was if you were getting money, the example was a teacher. You have a teacher that works for a school district, and you have the state giving the school district money to put in that teacher's pension plan. So it gives guidance if there's somebody that's giving you money so that you can put money in your employee's pension plan. It gives you guidance on how to deal with that. So you recognize the revenue when you get it, and then obviously the expense when you put it in the plan. The alternative measurement method for OPEB. This gives, is anyone using the alternative measurement method? It's usually pretty difficult, and I don't recommend it. But it gave some guidance on vesting and also the probability of people staying with your organization. And as discussed earlier, also there's a slew of other OPEB changes in this omnibus, and it kind of is GASB's way of fixing the mistakes they did on pension on OPEB, right? So, so they fixed the covered payroll piece in this. They fixed the using employer paid contributions, how to record those in this, just like 82 did for pension. And then they also fixed the Taft-Hartley plans. So if there's a plan that's, again, focused along like a union, so there's no primary government, it's an OPEB plan, it gives guidance on that, just like 78. Joke time. All right, what's the number? 6, okay. Let's see. Again, I haven't read all these. Oh, this is a statement. Be audit you can be. I don't know about that one. And here's another statement. It's an accrual world. I don't know. All right. So 86, so this is June 30, 2018, gives guidance on a defeased in substance debt. And this one is for using existing resources. So not using bond proceeds or refunding of a bond and putting that money in trust, but using existing resources to defease a debt. So you have too much money lying around, you want to pay off some debt. It gives guidance on putting it into a trust. Sorry, slide here. So you have to put an irrevocable trust to satisfy the scheduled payments. The assets of the trust that are going to be making those payments have to be essentially risk-free assets, so government-backed. And then it gives guidance on if you had prepaid insurance, how to calculate that reacquisition price. So the price, how much money you put into the trust versus how much is still outstanding on the debt. And then you have to add in that prepaid insurance to that calculation. And so that amount, the year it happens has to be disclosed. And then the disclosure going forward is the amount outstanding of the defeased debt. And you have to disclose if for some reason those assets set in trust change from a risk-free government-backed asset. Okay, so 83, so that's done with 2008. So 83, certain asset retirement obligation. I actually kind of like this one because I'm kind of a geek at heart, and I really like engineering and seeing how our water treatment plants work when I go to my water districts and that sort of thing. So this one's kind of interesting to me. So the new term is ARO, the asset retirement obligation. So this is going to be a liability that you have to put on your books when you have a legal responsibility to dispose of an asset a certain way, and it's going to be costly. So most of these would be, nuclear power plants, sewage treatment plants, not landfills. Landfills still go under GASB 18, those guidance. But even like, things you don't think about, like X-ray machines for hospital districts, those are something that has to be discarded in a certain way. So it requires you to book a liability and a corresponding deferred outflow, and then you would run that over the life of that asset, and to use the most reasonable estimate of future costs. So when to record a liability? There has to be an event, right? So there has to be an approval of, there could be an external event or an internal event. There could be an approval of regulations that, that you have to deal with something a certain way. There could be a contract. There could be a court judgment. It could be an internal event, the normal use of business of it, like a nuclear power plant. There's waste there produced normally. That's just part of it. Or it could be just by a purchase of an asset that you have this liability that you're going to have to pay later on. The initial measurement of it is really just trying to get a reasonable estimate. And it's really funny because it said that the most reasonable estimate that's cost, at a reasonable cost, that you can do at a reasonable cost. So you have to weigh into this estimate of the probability of things happening, which is kind of difficult to foresee the future. But you would look down the road to try to figure out what this thing is going to cost me to get rid of. So you book the deferred outflow equal to the asset retirement obligation, and then you would amortize that over the life of the assets. And this needs to be evaluated annually and changed if there's any major significant changes. And for the disclosure, it would be a general description and then of how you're coming up with those costs and what it's going to be, and then the date that you did your last evaluation of that asset retirement obligation. So 84, fiduciary activities. It describes 4 types. So we have our pension trust funds, our investment trust funds, our private purpose trust funds. We all love those, right? Our custodial funds. And it adds some criteria that they have to be a fiduciary if the government controls the asset and the government has the ability to change the beneficiary information or who is the benefit of those assets. So if you have control and can change who benefits, if those criteria are met, it has to be shown as a fiduciary fund. That's 2019. So 87. So leases. And this one is hot off the press. This one was just issued last month. So there's going to be more information coming on this down the road. Are we okay? Use that? Is that better? Sorry. Okay. So there's going to be more information coming down the road on this. And it really brings GASB in line with FASB requirements for leases. It breaks out between short-term and long-term. If it's short-term lease less than 12 months, this doesn't apply. It only applies to long-term leases. And it's really GASB trying to make a one-stop shop for all lease transactions. And it gets rid of, there's really no distinction between capital and operating. So I'm going to read you the definition that they give you. So it's a contract that conveys the right to use a non-financial asset, that'd be the underlying asset, the property, land, whatever, for the period of time in exchange or exchange-like transactions. So if it meets that definition, then you have to account for it this way. Rather, even if it's operating, if you think it's operating or capital. So this is a big change. And what you do is on the leasee's books, you would book a lease liability, so what your future minimum lease payments are going to be. And then there's a component of that, again, a probability component of that. If it's probable that you're going to terminate it early, that has to be included. If there's a purchase option, that has to be included as well. And then you offset that lease liability with an intangible asset. So at inception, the lease liability and the intangible asset will equal each other. And then you amortize that over the shorter of the life of the asset or the lease terms. And the disclosures for that are very similar to what we have now for capital leases. General descriptions, the 5-year payments, and then after 5 years, you can go 5 years in total until the end of it. Okay, and then for the leaseor, there is you would continue to depreciate the asset that you have out on lease, unless there's a requirement that the leasee return that asset in better than expected or same condition. Then you wouldn't have to depreciate it. And you would book a lease receivable, and again, every year that would go down. And of course, the lease receivable would have to be offset, and what would GASB offset that with? Deferred inflow. Okay, and then for this disclosure, it would be a general description, the cost and carrying amount of that property that's out on lease, total revenue received during the year on that lease agreement, and then future minimum lease revenue. So revenues that you would get back in that 5-year increment, and then 5 years after that, kind of like how we do our debt tables and things like that. And so as always, GASB is always a good research. Also, if you one of our clients and you get your accounting issues memo, look in the back. There's actually really good information about all of these. Some of you early ones that went earlier in the year probably don't have the 87 information, but we can provide that to you if you need it, because that's so new. All right, last joke. All right, let's see. Let's do a number. All right, pick a number. 3, okay. Okay, this one's probably actually geared toward me. How do you drive an accountant completely insane? Tie them to a chair and fold a road map completely the wrong way. That's a shot at me. All right, thank you guys.